Stop what you're doing right now. Seriously, if you hold any bank stocks in your portfolio, you need to hear this fundamental breakdown. Have you ever analyzed a regional bank stock during a shifting economic climate and wondered, is this a resilient cash-printing powerhouse or just a massive value trap waiting to happen? Well, consider this mind-boggling number. $5 billion. That is the exact size of the brand new share repurchase program that M&T Bank authorized in March of 2026. Think about that for a second. Think of share buybacks like a company sitting at the poker table. Well, M&T Bank just shoved an absolute mountain of chips straight into the center of the table. They are betting big on themselves. And I know, a major fear for retail investors right now is the shifting economic environment, especially with commercial real estate risks looming. But by the end of this explainer, you're going to know exactly what is giving M&T the confidence to make this massive bet. And we'll see if their underlying fundamentals actually justify it.
So welcome to the explainer. Today we're doing a totally objective, completely data-driven breakdown of M&T Bank's recent performance, their financial health, and where they currently stand in the market. We are cutting straight through the Wall Street noise, we're looking strictly at the numbers, and I'm going to give you a clear, actionable framework you can use to understand exactly what's happening under the hood of this financial institution. Here is our roadmap for today. First, we're diving deep into that $5 billion buyback. Second, we'll talk through the recent earnings and revenue engine actually funding it. Third, we'll test their capital strength and resilience. And finally, number 4, we'll break down exactly what Wall Street analysts are forecasting for the stock.
All right, let's jump right into Section 1, the $5 billion buyback. Let's unpack their capital return strategy. You know, capital return is arguably the single most powerful signaling tool a bank's management team has at their disposal. But what's really fascinating here isn't just the $5 billion sticker price, it's the context behind it. In late March 2026, M&T's board authorized this new program, and it actually replaces and outright terminates a previous $4 billion plan from January 2025. So this is a clear, deliberate escalation. They're ramping up. And guys, they aren't just making empty promises to hype the stock. They are aggressively acting on it. In the first quarter of 2026 alone, M&T repurchased $1.25 billion of its common stock. To put that into perspective, that is a huge step up from the $507 million they bought back in the fourth quarter of 2025. So they are actively and aggressively utilizing this authorization to pump value directly back to shareholders.
Moving on to Section 2, recent earnings and revenue. Let's see how they're actually paying for this massive buyback.
Because look, a buyback of that size is fantastic, but a bank needs a seriously powerful financial engine to fund it, right? Analyzing the short-term transition from the end of 2025 into the start of 2026, Q4 was a remarkably strong finish. Net income hit $759 million, with diluted earnings per share at $4.67. Now, stepping into Q1 of 2026, we do see a slight dip. Net income came in at $664 million, and EPS dropped to $4.13. But as always, context is absolutely everything. Even with this slight quarter-over-quarter cooling, the underlying core business remained incredibly stable. Just to give you an example, their non-interest income. It only decreased by a mere 1%. That's just $7 million quarter-over-quarter. So the engine is definitely still humming.
And when we zoom out and build this into the macro long-term picture, the revenue trend is just fascinating. Back in 2022, M&T Bank posted an annual revenue of $8.6 billion. But jumped to 2024? Boom! A massive leap all the way up to $13.4 billion. And then, for the full year of 2025, they leveled off into a highly sustainable $13.2 billion. What this tells us is that the bank didn't just catch a temporary tailwind or a brief spike, they have fundamentally elevated their baseline capacity to generate revenue over the last couple of years.
So, the crucial thing to ask here is, how does management view this performance? Well, this quote from their chief financial officer perfectly sums up the narrative coming out of 2025. Listen to this. Achieving a 16% increase in diluted earnings per share for the full year is obviously a massive win for profitability. But pay really close attention to that second part. They, quote, meaningfully reduced its level of criticized loans. This is huge. They aren't just making more money. They're actively improving the quality of their assets and stripping risk right off their balance sheet. It is a dual focus on growth and safety, which is exactly what you want to hear. That brings us to Section 3, capital strength and resilience. Let's assess their true financial cushion. Capital resilience is literally the foundation of any bank. It is exactly how we measure their ability to weather unexpected economic storms. First, let's briefly bust some banking jargon so we're all on the same page. You're going to hear the term CET1 a lot when analyzing banks. Common Equity Tier 1 is essentially a regulatory safety net. It's a key metric that compares a bank's core liquid equity capital right up against its risk-weighted assets. Put simply, the higher this percentage is, the stronger the bank's financial cushion will be if the broader economy suddenly takes a nosedive.
Now, let's talk about how M&T's CET1 ratio has shifted recently. At the end of Q4 2025, it was sitting at a very healthy 10.84%. But by the end of Q1 2026, it was estimated at 10.33%. Now, you might be wondering, wait, why did it go down? Is that a red flag? Well, remember that massive $1.25 billion share repurchase they just executed in Q1? And the fact that they're continuing to grow their loan portfolio? Both of those actions eat up capital. So this slight dip was a completely direct, expected, and strategic result of management choosing to deploy their capital into buybacks and actual growth, rather than just hoarding cash under the mattress. And here's another absolutely crucial metric you need to understand their financial engine: ROTCE, or Return on Tangible Common Equity. While CET1 measures their safety cushion, ROTCE measures pure, unadulterated profitability. It essentially tells us how efficiently and effectively the bank is generating profit from the actual, physical, tangible money that shareholders have invested in the business.
And honestly, M&T's track record here is a major selling point. They boast a 15 to 17% trailing 3-year ROCE. That is a highly efficient use of capital. You couple that with an 8% compound annual growth rate in tangible book value per share between 2020 and 2025, plus a really robust track record of dividend growth, you are analyzing a bank that is laser-focused on shareholder returns. But consider this final crucial piece of their strategy, because it directly addresses a massive pain point keeping retail investors up at night right now: commercial real estate risk. M&T is actively, strategically shifting their portfolio mix away from commercial real estate. Instead, they're leaning heavily into consumer and residential growth to ensure a much more balanced, resilient path forward.
All right, let's move into our final segment. Section 4, Wall Street Analyst Forecasts. Let's see what the pros expect. We've discussed the history and the current fundamentals, so now let's see what the market experts actually expect to happen next. What is really interesting here is the overwhelming consensus. Based on a May 2026 poll by S&P Global covering 20 different analysts, the clear majority view this stock as a solid hold. We've got 13 analysts rating it a hold, 5 saying strong buy, 1 buy, and just 1 lone analyst giving it a strong sell. Now, a hold rating generally means these analysts believe the stock is going to perform roughly in line with the broader market. It's a sign of stability, right? Even if it maybe lacks the expectation of an immediate explosive breakout. But when you actually dig into the why behind these ratings, several really positive themes start to emerge. First up, profitability. Analysts are specifically noting that earnings and net interest margins steadily improved all the way through 2025. Second, investor backing. Wall Street absolutely loves the combination of aggressive share repurchases, dividend increases, and those resilient CET1 capital levels we just talked about. And third, sustainable growth. Despite the strategic shift away from commercial real estate, which does temper headline loan growth a bit, guidance for 2026 still points to continued increases in net interest income, average loans, and average deposits. So it really paints a picture of measured, methodical, and safe expansion.
So what does all of that actually mean for the stock price? That brings us to our final number for today, $233.17. That is the average one-year price target from those polled analysts. When you compare that to the trading price at the time of the report, which was hovering right around $214, that represents a steady upside of nearly 8.9%. It's not some speculative overnight moonshot, but rather a reflection of solid, compounding, fundamental value.
So, we finally arrive at the ultimate question. We've seen the massive $5 billion buyback, we've seen the elevated baseline revenue, the strong capital ratios, and Wall Street's expectation of steady upside. But does M&T Bank's resilient profitability and capital return program outweigh the broader, shifting risks in the macroeconomic environment for your own portfolio? I highly encourage you to take this framework, dig even deeper into their SEC filings, and decide for yourself if you're ready to bet on this banking giant. Thank you so much for joining me for this explainer. Keep learning, stay curious, and I'll see you in the next one.